ever heard the term accredited investor and wondered whether that's you or whether it even matters? This video is going to clear that up completely because the answer affects what investments you can access, how you're protected, and what your options actually are. Let's start with the basic question. What is an accredited investor? The SEC, which is the Securities Exchange Commission, is a federal body that regulates investments. It defines an accredited investor as someone who meets at least one of these criteria. You have an annual income of at least $200,000 as an individual or $300,000 combined with a spouse for the past 2 years with a reasonable expectation of the same this year, or you have a net worth of over $1 million, not counting the value of your primary residence. There are also some newer qualifications that were added in 2020. You can qualify based on professional certifications like holding a Series 7, Series 65, or Series 82 license. So it's not just about wealth anymore. Knowledge and credentials now count. So that's the definition. Now let's talk about why it matters. The reason accredited investor status exists is investor protection. The SEC's position is that accredited investors, by virtue of their income, net worth, or professional knowledge, are better equipped to evaluate complex, higher risk investments and absorb potential losses. So certain private investment opportunities are only legally available to accredited investors. Private real estate syndications are one of those opportunities. When you invest in a publicly traded REIT, which is a real estate investment trust that's regulated, publicly available, and anyone can buy it, but when someone like me is raising private capital to purchase a specific apartment community, that's a private securities offering. And the rules around who can participate and how we can talk about it publicly are very specific. I'm not going to get into the legal details of offering structures here. That's a conversation to have with a securities attorney or a financial advisor. What I will say is this: the way private real estate operators are allowed to market their deals and who they're allowed to accept as investors depends entirely on the structure they've operated under. Some structures are more restrictive, some allow broader outreach. It varies and it matters. Now, what does this mean for the everyday investor, the mom and pop who have worked hard, saved well, maybe has a 401k and some equity in their home, but doesn't hit that 1 million net worth threshold yet? First, you have more options than you think. Publicly traded REITs, real estate crowdfunding platforms that serve non-accredited investors, and real estate investment through retirement accounts are all legitimate paths to real estate exposure without needing accredited status. Second, the accredited threshold is not out of reach for many people who think it is. If your home equity doesn't count, run the actual math on your other assets, retirement accounts, investment accounts, business equity, other property. You might be closer than you think. Third, accredited status is not a guarantee of a good investment. It's a legal threshold, not a quality filter. Accredited investors lose money on bad deals all the time. Due diligence matters regardless of your status. How do you become an accredited investor if you're not one yet? The income path. Build your earned income to $200,000 for an individual or $300,000 threshold for a household and sustain it for at least 2 years. The net worth path. Build investment assets outside of your primary home to the $1 million mark. This is more achievable than it sounds for people who have been consistently investing in retirement accounts over their career. The knowledge path. If you work in finance or securities, check whether your existing licenses qualify you. Series 7, 65, or 82 holders now qualify, regardless of income or net worth. There's no application process, no certificate you can receive. When you invest in a private offering, the sponsor will ask you to self-certify your accredited status. Sometimes with documentation, that's how it works. Here's the bottom line for why I'm making this video. We work with accredited investors. That's the structure we operate under, and we're not in a position to change that for individual situations. I believe in financial education, and I think too many people either assume they don't qualify when they actually do, or they don't understand why the threshold exists in the first place. If you're working toward accredited status, keep going. The investments available on the other side of that threshold are genuinely different in terms of return potential, control, and asset quality. And if you're already there, or if you're not sure, talk to a financial advisor or a CPA who can look at your actual numbers and give you a real answer. One more thing before I wrap this up. We invest in Class B multifamily apartment complexes in the Twin Cities suburbs, Eden Prairie, Plymouth, and we've recently added Rochester to the mix. Rochester specifically because of the housing demand driven by the Mayo Clinic and the broader medical and biotech ecosystem out there. Strong employment, stable tenants, undersupplied housing, that's exactly the kind of market we want to be in. If you're an accredited investor who wants to learn more about how we invest, what we look for in a deal, and how passive investing in multifamily actually works, reach out. Link is in the description. No pressure, no pitch, just a conversation. And if this video has helped you understand where you stand as an investor, share it with someone who's been asking the same questions. These are conversations more people should be having.